Hello from sunny Portugal. I'm here for a couple of weeks and then afterwards I'm on to Dubai and India. And then last but not least, back in beautiful Singapore. Yes, it may be a summer break for many of us, but we're still committed to doing those daily videos that will help everyone understand the sometimes complex world of cross-border transactions as we and our team of tax advisors seek to demystify that sometimes confusing world. My name is Darren Joseph. Please visit hg.tax. We have over 1,000 videos, over 2,000 articles on completely free of charge on cross-border tax issues. So I'm recording this particular video slash podcast in August 2023. At this point in time, I want to make sure that I mention the date because what I'm going to discuss is, it's an evolving topic. So potentially by the time someone may watch or listen to this, circumstances may have changed. But this is the situation as at August 2023. At this point in time, former FTX chief Sam Bankman-Fried, that I'll refer to as SBF going forward, he's in jail, real jail. So he's a guest of the notorious Metropolitan Detention Center, the MDC, in Sunset Park, Brooklyn, which is in New York, those who don't know, which has housed such celebrities as Jeffrey Epstein and Ghislaine Maxwell. So anyway, so he is alleged to have engaged in witness tampering. SBF showed former Alameda Research CEO and who happens to be his ex-girlfriend, Caroline Ellison's personal journals to a New York Times reporter in an apparent attempt to influence witness cooperation. Now, SBF is awaiting trial, but will appeal his temporary incarceration, most likely, and SBF will what's more important, SBF will have a laptop with internet access while in the MDC. Anyway, so regardless of what happens, I think many of us believe that he will take a fall for all that went wrong with FTX. SBF may be a patsy in someone else's larger scheme. That there's a strong sentiment that this may be the case, but he's a public face, and so he'll probably serve real time. Now, the political contribution charges were dropped from his indictment. However, a superseding indictment was filed with 7 new charges. So he's newly charged with using 100 million of customer funds to make campaign contributions. Allison, his ex-girlfriend, is expected to testify that SBF told her to move the customer money. Anyway, meanwhile, switching over to Congress. So, crypto's friends in Congress are advancing the cause of protecting them from the SEC. Now, the House Financial Services Committee reported out a bill for regulation of stablecoins, the Clarity for Payment Stablecoins Act, as the SEC overcame a motion to dismiss a stablecoin product that promised an investment return. This is SEC versus Terraform Labs Private Limited in Singapore, the Singapore entity. Anyway, this is in the Southern District of New York. This happened at the end of July 2023. Anyway, so trouble for crypto fans, potentially, is that even the friendly lawmakers are starting to understand how dangerous an unregulated parallel financial universe is. And this universe, I want to mention, does include the unlicensed promoters or online influencers. You guys need to be careful. The reason is when it comes to financial products, it's been a long time, but for decades, there has been no free speech. There is no free speech when it comes to regulated financial products. It's heavily regulated. Promoters tend to need to be licensed or at least operate under an institution that is in turn licensed. And one needs to be careful in what you say, so that you don't intentionally or unintentionally mislead consumers who would then lose their money. Anyway, now focusing on staking. Staking rewards are now clearly reportable. This question was addressed by a revenue ruling. Anyway, some crypto platforms do already provide 1099 MISCs, so 1099 miscellaneous, to miners and stakers, who then have no choice but to report it. Of course, the question on the front of the 1040 already asks people to report mining and staking rewards. So the IRS is playing catch up in, progressing through what are basic income tax questions that have been asked for quite a few years now and should have been answered way a long time ago. So anyway, so I'm talking here about Revenue Ruling 2023-14. So it basically concluded, this is the Cliff Notes version, the quick version, that crypto asset stakers don't have to recognize the income until the awarded assets have become transferable, which is something that this is a premise even before this came out that we've been working with our clients. So I think most practitioners like us who adopted a more conservative stance, this came as no surprise. For those who being a bit aggressive, oops, maybe you guys need to go and amend some returns, up to you, right? So anyway, but however, the ruling is admittedly narrowly drafted, so its implications for more sophisticated taxpayers are unclear. So anyway, you just need to talk to your preferred advisor. But in the meantime, let's just jump into staking some more. Now, ETH uses proof of stake validation. Bitcoin uses proof of work. Proof of stake is becoming the prevailing validation method because proof of work just uses too much energy. So that could only really be performed where power is pretty cheap. So some investors delegate their staking to specialized staking service providers, which provide which operate pools and offer high yields. So retail investors can avail themselves of staking services offered by these platforms. These service providers can take as much as 25% of staking rewards as their compensation. Now, staking requires a large amounts of crypto assets to prevail in a contest where other stakers with other competing stakers to see which one would earn the chance to validate new blocks of the same crypto asset. So the largest deposit usually prevails in the contest, or validation rights can be allocated proportionally to the amount staked. Anyway, assets put on deposit for staking are tied up during the contest for the chance to validate and during the validation process. Now, this is important to understand, right? So once choosing to validate, the staker must validate the new block successfully. Validation is similar to mining in that the computer power is used to run computations that have to be verified by other participants. Now, validation is performed on a node, which is a device holding a duplicate of a blockchain ledger on which computations can be run. Now, if the validation succeeds, the staker gets a reward of additional units, plus fees denominated in units. If the validation fails, the staker's stake is slashed. That is reduced by a penalty. Now, in the ruling, so I'm just kind of creating the context now. Let's go back to the ruling. So in the ruling, the taxpayer stakes, so the ruling is about a particular scenario. Anyway, so in this ruling, revenue ruling, the taxpayer stakes 200 to 300 native crypto assets on proof of stake blockchain on which they were created. The taxpayer stake is selected, so they won, giving the taxpayer the chance to validate new blocks of units of the same crypto asset. The taxpayer successfully validates the blocks and becomes entitled to a reward of 2 new units. So now we're not told in the scenario whether the taxpayer is an institution or an individual, only that the taxpayer is on the cash method. We don't know whether the taxpayer is using delegated staking or has its own node. Anyway, so the IRS clarified that delegated staking through a platform would not change the tax treatment. The ruling crucially stipulates that for a period after the taxpayer becomes entitled to the reward of 2 units, the taxpayer lacks the ability to sell, exchange, or otherwise dispose of the 2 units in any manner. That's in quotes, in any manner. So these lockup periods are normal practice and can cross tax years. So in the case of ETH, the Ethereum staking, the lockup period was about 18 months when the rewards showed in the staker's account. Thus, the rewards are includable in gross income at the time the taxpayer gains dominion and control. So that's a key thing, and this is a concept that predates this particular revenue ruling, 2023-14. So the idea of dominion and control was something that us and other, again, conservative practitioners were kind of using all the while. So anyway, so the fair market value of the reward units is determined at that point in time where the taxpayer has dominion and control. Anyway, so I mentioned that we fall in the conservative camp because some stakers have been arguing and probably still will argue that they should be allowed to wait to recognize income until they exchange the rewarded assets, the assets they receive for money or other property, on the view that staking is akin to like gold mining or oil drilling. Some even argue that rewards were self-created assets like a work of art because no person made a payment, right? So that tax should be deferred until disposition. Anyway, the revenue ruling makes it clear that the IRS disagrees with this whole self-created asset argument. But, what does this mean? This means that, from our point of view, from my point of view, transacting in crypto clearly is not, has not, and for the foreseeable future will not be seamless or cheap. Despite the rhetoric about it replacing banking, there are fees at every turn, and the revenue ruling doesn't even discuss fees. But if the taxpayer uses delegated staking, as many do, fees may not be broken out anyway. So the ruling does not express an opinion on whether staking is a service. The revenue ruling implies that staking is some sort of dealing in property, like rental, that produces income. The ruling suggests that the IRS believes that the person performing the proof of stake function has ordinary income. And, that's a kind of blow to those who are looking for capital gains based on whatever concepts that they had. So it kind of just confirmed what those of us who have already taken a conservative position with our clients already believe. So yeah, it is what it is. So that's a bit of an update on the income recognition for crypto staking and what's going on with the very notorious individual, who is a SBF. Please continue to look at our videos or listen to our podcast, those which are relevant to your situation and to your case or your areas of interest. Or feel free to jump on our website. We have like over 2,000 articles, which are freely available to you as you seek to demystify this confusing world of international tax. My name is Darren Joseph from HEJ.tax.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.